Hi, I'm Gordon Lamphere, and welcome to the Real Finds Podcast, where we have real conversations with key entrepreneurs, activists, and researchers who are shaping the real estate industry and, as a result, our world. On today's podcast, we explore the state of industrial real estate with Xander Snyder. Xander is the senior commercial real estate economist at First American. On the podcast, we take a deep dive into the Midwest industrial market, including sales, leasing, and capital markets. Most of all, we dive below the surface of the data, and he uncovers the good, the bad, and the ugly of hidden distress and opportunity for investors. If you're evaluating Midwest real estate assets, this podcast is well worth a listen.
Xander, thank you so much for hopping on the podcast today.
Pleasure to be here, Gordon. Thanks for having me.
So, why real estate?
Why real estate? That's a very, very broad general question. My background in real estate, or just why real estate generally?
What got you into real estate?
I come originally from a family office direction. My family's been investing in real estate in LA for the last 50 years. I've been investing directly for the last 15 years myself, either in direct ownership or limited partners. And essentially, I wanted to go back to grad school and mix some technical expertise with this domain expertise that I have. And that's kind of how I got to where I am here. I think it is a great industry to apply new technology to. We tend to adopt new technology a little bit more on the slow side. So I like taking a data-driven approach to the commercial real estate world.
So let's get into the data then. So what are we seeing in the industrial market right now? Generally, we're seeing certain things in the Chicago market from our perspective. What are you seeing?
Well, maybe we can start at a high level and then drill down to some of the larger markets in the Midwest. But for folks who aren't familiar, we just had a huge boom in industrial construction over the last several years. This is driven by a combination of, I guess your audience is probably already familiar with this, right?
Or if you've ever driven a car anywhere for more than maybe a mile, you've probably seen an industrial facility being built somewhere.
I think that's right. There's a lot of new supply. It was driven by a combination of a surge in demand during the pandemic days and very low construction financing costs. And as a result, we hit an all-time high of new industrial construction in the third quarter of 2022 at around 700 to 800 million square feet under construction across the country, kind of depending on the source that you use. Since then, that supply has been delivered to market. And as that's happened, new construction starts have fallen. So I'd say we're in a bit of a rebalancing phase right now because demand has fallen off for a number of reasons. It's become a little softer, even though I think the long-term demand for industrial or the long-term demand drivers for industrial are really still quite strong. And so we're dealing with this supply wave now, even though we know that future supply will be at least somewhat limited. Now, in the Midwest, you have five, if we just focus on the five largest cities, and I'm doing this not by population, but by stock of industrial square footage. So it's Chicago, Detroit, Minneapolis, Indianapolis, and Columbus. The characteristics of new industrial space that has been added has varied a little bit. And as a result, the stock of industrial space in those cities has changed over the last 5 years compared to pre-pandemic. And they've changed a little bit differently. I think sort of the characteristics of that stock is something interesting that we can get into. But how about I'll pause there and say that broadly, these markets have followed the national market.
So what are the biggest characteristics changes? I'm just guessing from the data that I see that we're seeing a lot more large box construction. Would that be accurate?
Yeah, absolutely. There has been far more large box construction across these five markets over the last several years compared to small box. Now, it's varied even between these five major cities. So, for example, if you look at the average building size, average industrial building size delivered over the last several years, it got to be the largest in Indianapolis. You had on average 350,000 square foot buildings being delivered sort of towards the end of 2023. Columbus came in second place at about Indianapolis was 350,000. Columbus was about 300,000 at its peak, followed by Chicago at about 250,000 square foot properties, followed by Detroit and then Minneapolis was on sort of the low side. So even though you saw an increase in the average size of properties being delivered in Minneapolis, it didn't increase by a whole lot. And in fact, right now, properties being delivered in Minneapolis are roughly on par with the average size of industrial properties pre-pandemic. Detroit saw more of a spike in immediate pullback in average building size delivered.
And why do you think that is, that certain markets had massive spikes relative to other markets?
Sure. Well, I think a lot of it has to do with local incentives, but also where these cities are positioned in major logistic and distributional lines. It's, everyone always says in real estate, location, location, location. Well, when it comes to industrial properties, the location it needs to be along the main arteries of transportation and moving goods. So that will impact the types of properties and the size of properties that are built in these different cities. But then, of course, there's a lot of diversification within industrial as a broader asset class. So a lot of folks are probably most familiar right now with warehouses and logistics centers with, 50 bays where trucks can pull up and either deliver things into a warehouse or pull them out. But then there's, of course, manufacturing facilities. And if you look at the stock of industrial properties in Detroit, it's overweighted towards manufacturing properties compared to, as an example, Indianapolis and Columbus, where it's overweighted towards these warehouses and 3PL facilities. And interestingly, the average stock or the average size of properties in Detroit, even though we had a growth in deliveries over the last several years, has not grown by all that much compared to Columbus and Indianapolis. So as an example, the average building size in Detroit has only grown by about 2% compared to Columbus and Indianapolis, where inventory-wide, it's grown by like 30% over the last several years. So that gives you a sense of sort of the relative change in the size of the average industrial properties in these cities.
So which of these markets are absorbing the supply well, and what markets are lagging?
Yeah, so you basically have amongst the top, 10 markets. Let's expand a little bit now, just so that we have a little bit of a bigger sample here. There are, I'd say, 4 different groups in terms of cities where new supply is being absorbed or new supply is not being absorbed at different paces. So in this first group, current absorption is outpacing deliveries by a fairly substantial amount. And within this category, you have Dayton, Ohio, Omaha, Nebraska, and St. Louis, Missouri. In group 2, you have cities where you have demand that's just beginning to balance out against supply. So there was a bit of a supply wave, and now demand has just started to catch back up to it, but it's not necessarily exceeding new supply at a rapid rate. And cities in this category include Cincinnati, Indianapolis, Kansas City, and Minneapolis. In group 3, these are cities where you have new deliveries substantially outpacing absorption. So new supply is higher than new demand. And this includes Columbus, Ohio, Detroit, and Toledo, Ohio. And lastly, in group 4, these are markets where the supply and demand balance was previously there, but now it's kind of falling out of balance a little bit. So, for example, in Chicago, Cleveland, Milwaukee, and Grand Rapids, Michigan, you had balance, but now supply is outpacing demand in these cities, so it's kind of fallen out.
And with all this, what's primarily driving it? Is it labor pools? Is it because of the nature of the industries, logistic versus manufacturing? Are there incentives at play? What's primarily driving things?
Sure. Well, certainly when it comes to industrial demand, and in this sense, I'm measuring it by like rent growth, right? So demand for the space itself from the landlord's perspective, there's a very strong correlation between the availability of industrial labor, so the labor supply in a given area, and industrial rent growth. You have to have the skills available in your local market in order to justify the construction, and you justify construction with historical positive rent growth. So that's been a major factor of it. And in terms of just the amount of supply that's come to market, I think that really is a combination of what we were talking about a moment ago with where these cities are located specifically on these major transportation arteries across the country. That's one. Two, local incentives, because it varies substantially over the last several years. What municipalities have encouraged, what incentives have existed in different municipalities to encourage construction, and lastly, there's what types of properties it makes sense to build in each of these places. So this kind of comes back to the labor pool, but you can imagine that manufacturing skills is substantially different than logistics skills. So if you have a lot of people who in a given city have experience working in a warehouse, that's not really the same as working in a steel manufacturer. So all of these things kind of combine into driving the supply and demand in each of these different cities.
So within the product types, is there a wide variance in what we're seeing in terms of vacancy by size of these buildings? Like, are there certain markets that are having, relatively limited small bay or mid bay or big box supply? And kind of how is that playing out market by market?
It's a great question. And let's, for the sake of the argument, just say that below 50,000 square feet, that counts as a small bay property. 50 to 200,000 is a mid bay, and above 200,000 is a large bay or a large box. Now, one thing that's actually a trend that's actually shared across all of these major Midwestern metros that we're talking about is that large box vacancies are much higher right now than small box vacancies. And across, let's see, I actually have the top 5 here in a chart already. So across the top 5 major Midwestern metros by the size of industrial inventory, large bay vacancy rates right now are at about 7%, and they peaked at about 8.5%. So that's above 200,000 square foot properties. The mid bay vacancy rate is at about 5% right now, so meaningfully lower. And small bay is only at around 3%. So there's really a bit of a mismatch right now in terms of demand for large properties versus small properties. And I think there's a number of interesting trends driving that disparity. One is, just as we talked about, most of the major new construction has heavily weighted towards very large property sizes. Most of the new properties are big, tall ceiling properties that you can store a lot of goods in, and you can consolidate a lot of your operations in. The challenge, though, is you have to be a tenant of a certain size in order to need a 500,000 square foot warehouse. And so that kind of limits your demand base for that particular type of space. For smaller properties, small bays, they may be a little bit older on average. They might not have those high ceilings. They might not have all the modern amenities, but in absolute dollar amounts, it doesn't cost as much to lease them. So you have a broader prospective tenant pool to pull from. And in addition to this mismatch between your tenant pool, over the last, I'd say, year or so, especially as some of the uncertainty around trade policy has been introduced, which impacts where exactly we're going to need all of these transportation nodes across the country, you've had a lot of big industrial tenants kind of in this wait and see holding pattern. And as a result, they've either been consolidating some of their options or consolidating some of their operations into fewer buildings, or just deciding to hold off on those major leasing decisions. A 500,000 square foot warehouse costs a lot to lease. And if that's a big financial decision and you don't exactly know where your operations are going to be needed in the next 3 to 4 years, you're more likely to press pause. And as a result of this particular dynamic, we actually saw net absorption for industrial space across the country fall in the second quarter of 2025 for the first time in 15 years, which just means that more space was vacated than was leased. So you have all of these different dynamics impacting the variability between vacancy rates in small and big boxes.
Yeah, I know within our Illinois and Wisconsin portfolio, we've seen a lot of companies pressing for 1 and 2 year renewals, where typically they were doing 5 and 10s. That's not wildly different than what we're seeing. In terms of some of that rebalancing, though, and I know you mentioned it, what do you see in terms of the construction pipeline and product that looks to come on the market? Are there Are developers generally looking at this and saying, well, there's a lot of vacancy in certain sections of the Midwest market. Maybe we're not going to look to bring product online here? Or are we just seeing people going ahead full steam and just betting on, 5 or 10 years down the line in the future?
I think builders are becoming a lot more cautious, a bit more circumspect, especially when it comes to speculative deliveries, which just means that a property is delivered without a tenant ready to go in place at delivery. And over the last year or two, about 60 to 70%, depending on the market, of new industrial supply has been spec space, so speculative space. The remaining 30 to 40% is built to suit, which just means you have a tenant that has specific needs, and so the developer builds around those specific needs. So developers backing off a little bit on the spec space, especially in in high supply areas. So, for example, Eastern Indianapolis is one place that has received a lot of new supply over the last 2 to 3 years, and builders are getting a little bit more cautious about adding to it, especially because the industrial vacancy rates it's already like 10%. So, I think we're seeing starts fall. We're seeing a gradual risk off transition to more build to suit space for those developers that are active right now, and just general caution about delivering a big new empty box in a market that may already be oversupplied, at least in the near to medium term.
So, in the near to medium term, it would seem that the most profitable section of the market is probably small bay. And I'm curious what you're seeing in terms of opportunities that developers are looking at in the pipeline or just the market in general for some of our investors who might be looking to get into the small bay space.
Sure. Well, I think there is a bit of an opportunity here because, as you can imagine, if you're a tenant, you think about size of your box and amenities. And typically, as we said a moment ago, newer, highly amenitized buildings have typically been very large buildings or larger buildings. The smaller bays are typically older buildings. They've been around for a little while. But because you have that mismatch of demand and a smaller demand pool for the very large buildings, I think there's an opportunity for small bay developers to offer new upgraded product, new upgraded inventory to the market that can compete better with those existing small bay properties, but have more amenities at a given size. So I do imagine that we will see some construction activity pivot more in that direction in the year, 18 months to come, unless some of the uncertainty in the broader macro economy kind of teeters out, and we have a better long-term direction for where the demand for that for very large industrial space is going to be 5 years from now.
Are we seeing particularly strong rent growth in that section of the market? I know one of the biggest factors I hear on the phone, typically with the investors that we work with, is that they still feel rent growth in, for example, the Chicago market is lagging relative to the cost of construction. What are you seeing across the broader Midwest?
I don't have the rent growth numbers at the very top of my head right now, but as you can imagine, there's a fairly strong correlation between vacancy rates and rent growth. Where there's lower vacancy rates, rent growth is typically higher because there's less supply of space to go around. So, um, given that vacancy rates for small bay buildings are so much lower right now, and they're dealing less with that onslaught of new supply, rent growth is probably going to be a good deal more resilient in those smaller boxes in the years to come. The trade-off, of course, is that those smaller boxes or smaller bays typically tend on average to be a little bit older. So there is that trade-off on the rent growth side of things. Um, I do think that uh, in the years to come, it will depend in large part on how much certainty we're able to achieve in terms of maybe the next 5 years, if you want to call that long term, on some of the macroeconomic policies macroeconomic uncertainty that remains outstanding. But I do imagine that given the limited availability of small bay space to go around, that rent growth there will be more resilient than in the large box sector.
So, talking about resiliency, the industrial market has been generally pretty resilient for investors. What are investors seeing right now in terms of cap rate spreads and kind of how they're underwriting deals?
Sure. Well, cap rates for industrial properties have increased fairly substantially compared to the trough reached in 2022 or so by about 150, 170 basis points nationwide. Um, so that you have some positive spreads in the industrial space depending on the type of debt capital that you can access right now. That's positive. It also means, of course, that valuations are adjusting and will continue to adjust, especially as this vacancy overhang is kind of worked out in the next several years. Uh, we are seeing more concessions offered to tenants, prospective tenants, especially in the large box area, because if you can imagine, if you're a developer that has just delivered a lot of new spec space to market and you're uncertain of where the demand for that space might be, it's just better to get at least, even if you have to take a little bit of a cut up front on your prospective rent in order to kind of offload that risk and move on to the next thing. So I think that's one of the major trends that's going on right now is rent becoming a little bit softer on the large box size, large bay side of the market. And this is being offered through build out incentives and different lease concessions, so on and so forth. So I do think the positive there, as you mentioned, is that we're re-entering positive leverage territory. When over the last several years, almost any debt that you could take out was going to be higher than your cap rate. So that will likely bring a lot of purchase demand back to the market, even with this vacancy overhang.
How does that boil down market by market? Are there certain markets that are overachievers and others that are underachievers in the Midwest?
Well, I don't have at the top of my head right now market by market level spread data for cap rates versus mortgage debt. But what I can say is we can get a sense of how far along the top 5, top 10 Midwestern markets are towards stabilizing. And we kind of talked at the head of this episode about this rebalancing act between the new supply and demand kind of softening. But ultimately, there are a lot of long-term drivers for industrial demand, for industrial space. And this, I mentioned this only because 10 years down the road, I think we're going to need more industrial space than we currently do. So that's the long-term trend, even though there might be disruption in the medium term. Now, if you look at some of these Midwestern markets, you can get a sense of how far along they are in this rebalancing process by looking at the spread between availability rates and vacancy rates. And the difference here is vacancy rates are essentially a measure of how empty space currently is right now. Availability rates is a bit more of a forward-looking measure of building emptiness because it considers space that might be occupied right now, but is listed and is going to be on the market for lease in the near future. So when you have an availability rate that's much higher than a vacancy rate, that suggests that that market is not very far along in the rebalancing process and that vacancy rates will probably rise and approach the availability rate. So in the top five markets by the quantity of industrial space, we have Chicago in first place. And there, the availability rate for industrial space is about 8.5, 9%, and the vacancy rate is only 6%. So you have a meaningful spread, which suggests that the rebalancing process for Chicago is not all that far along and there's more to come. Detroit has a smaller spread, but similarly, you have availability rates above vacancy rates. When you get to Indianapolis and Columbus, interestingly, even though they had some of the greatest growth in industrial stock over the last 5 years, I mean, Indianapolis and Columbus saw the stock of their industrial base grow by over 20% compared to fourth quarter of 2019, pretty substantial growth. And yet, the spread between their availability and vacancy rates are very narrow. In fact, they're almost right on top of each other. And what that suggests is they're probably closer to being fully rebalanced. So a lot of the pain has probably already been experienced in Indianapolis and Columbus compared to, say, Chicago.
And within all these industrial markets, there are huge gaps between the different asset classes that are within industrial. And I'm curious, going over and taking a dive into asset classes like iOS, cold storage, and data adjacent uses, where are we seeing sub asset class growth or potentially contraction relative to the market?
Sure. Well, I mean, just to start with industrial outdoor storage, iOS, it's really become, it's gone from an extremely niche market pre-pandemic, largely dominated by, mom and pop operators or small business or small family offices owning different properties, and it's typically required a fair amount of expertise in that one specific area. But what has happened is as the pandemic hit and the demand for all of this industrial space grew, uh, you basically needed nearby land to store all of the machines that are used to move goods in and out of these warehouses. And that's where the demand for industrial outdoor storage really began to take off, especially infill industrial outdoor storage. So places in urban centers that are as close to these larger warehouses as possible. You got to put the cars, you got to put the trucks somewhere. And as a result, we've seen a real surge in demand for iOS. And gradually, a lot of, maybe not a lot, but you've seen more institutional capital beginning to buy up a lot of these smaller owners that have typically held this property for a good long while. And this suggests that there's opportunity for a roll-up strategy here. So something that was a little bit more prevalent in the self-storage market maybe 5 years ago, you go and buy 10, 15, 20 different individual self-storage properties that become a single property or a single portfolio rather, and then you can sell it on to the next maybe middle market player. That sort of dynamic is beginning to happen in industrial outdoor storage. Uh, Cold storage is an interesting market, and it's been in fairly high demand. It's restrained in where you can create new space relative to iOS because you need a lot of electricity in order to keep things cold in the cold storage. But as you know, supply chains for food, if they're disrupted at all by tariffs, then the need for where this space needs to be might change slightly. Interestingly, I heard the other day that the rise in demand for GLP-1, the drugs, so like what are they called? Is it Monjaro and the things that
Ozempic
help?
and yeah.
Those all need to be stored in cold facilities throughout the entire supply chain process. It's kind of similar to the COVID vaccine, actually, too. There's a really strong surge in demand for cold storage because we needed to keep the vaccine below a certain temperature when we first started shipping it out several years ago. So I think that that's a very interesting niche sub-asset class within the broader industrial market. It is location constrained in a way that iOS isn't because of the utility requirements. And in that sense, it's a little bit more similar to data centers, although, of course, there are differences between the two as well.
And what have you seen in terms of data center growth? I mean, we get calls at least every day, sometimes multiple times a day, for all these various funds reaching out to try to find huge blocks of land with ample power and zoning to facilitate a data center. What are you seeing in terms of data center growth in the Midwest, and how is that kind of shaping the market just in general?
Um, it's fairly substantial. There's an incredible amount of capital chasing data center space right now, either construction or in the purchase market. I think interestingly, if you look at some of the like valuations of public pure play data center REITs, they're quite high. So you might argue that at least in public equity markets, maybe a lot of the prospective growth in the AI market is already baked into some of the valuations. But that's kind of a longer drawn out conversation. There is a lot of land that could potentially be used for data center development in the Midwest. I don't live in the Midwest, but I recently traveled there. I was in Chicago and Indianapolis and Detroit. And in Indianapolis, there's discussions of a new big data center going in, but there's quite a lot of opposition to it locally. And unlike some 3PL logistics types of industrial properties that both need a lot of industrial labor in order to function, but also create those jobs when they're brought to market, that's not necessarily the case with data centers once they're up and running. It takes a lot of construction labor to get those things built, but not quite as many to run. And so there's a little bit of political opposition going on in some of these places that could potentially be new big data center locations.
I mean, just generally, I'll tell you on my side, we've seen huge pushback with data centers in our region, in Chicagoland. And what's interesting is with trucks, just as you mentioned, there are a lot of jobs and opportunities around trucking and logistics, and we see typically the pushback is the immediate neighbors. But with data centers, it's a whole municipality or county area, based on the fact that data centers tend in many markets, based on a lot of municipal deal making, to drastically rise up electrical costs as well. So you have a whole plethora of people who are sometimes pushing back versus with trucking, unless you're really 2 or 3 houses away, you really don't notice it.
Yeah, exactly. If there's all of this new demand for electricity and it impacts everyone in the neighborhood, you can very clearly imagine if the community is not directly sharing in the economic upside of that data center, but they're sharing in the costs, they're not going to be thrilled about it. And this is part of the reason why there's been a lot more discussion about power plants dedicated specifically towards specific data centers. So there are discussions about the modular nuclear power plants that are beginning to become popular, but they're not very widespread yet. So one of the main ways that these dedicated power plants, or one of the main types of dedicated power plants that you have right now, are natural gas. And so interestingly, that's kind of resulted in a shortage of specific parts for like natural gas turbines and stuff like that. But unless you, as the data center owner, are able to kind of sequester the community off from those increase in prices, you have to imagine there's going to be local opposition to more of these being built.
Yeah, we've had a number of guests on the podcast, and we're having more actually this week on the data center topic. So I want to move to one final portion before we wrap up our final four. For all these municipalities and regions and areas in the Midwest that have seen industrial growth, what do you think are the biggest constraints on supply besides just investment from developers?
That's where my mind went as the first major constraint, because if you have a lot of existing competition, a lot of existing supply, it's going to be harder to justify, or it's going to be harder to underwrite new projects. So I think that is a major constraint, but I know that, let me think about some of the other ones. I don't have a great answer for you, honestly. I think the major constraint is going to be access to capital. It's going to be access to utilities in the case of specific sub-asset classes. But that's kind of where I think you're going to run into a lot of the challenges: expensive construction financing and equity capital that's somewhat fearful of high vacancy rates that may persist for the next 3 years or so.
And I know we've had guests from a couple REITs on that have talked about energy being a major factor, and I know you mentioned that. Are there certain markets that have particularly strong energy infrastructure that could more easily handle some of the demand and growth in many of these high energy asset classes? Data centers, cold storage, just generally manufacturing. As we see manufacturing potentially ramp up, which markets do you think are best positioned for that versus just generally the Midwest in general?
It's a great question. I don't have the data at the top of my head. I'd like to go answer that question, but it'd be a function of megawatts or gigawatts produced in different cities and transmission capabilities, but I don't know that right off the top of my head.
So let's get to our final four. It's always kind of a nice wrap up and a way that we can kind of understand a little bit more about you and a little bit more about where commercial real estate markets are going. So I'm curious, what do you think is going to have changed the most about industrial real estate, industrial supply, and kind of the industrial commercial real estate market in general?
Sure. Well, I think 10 years from now, we'll see that our need for commercial real estate space more broadly, but also industrial specifically, will have changed a lot compared to pre-pandemic. So that shock has really changed the balance of how much commercial space we need. We need a lot less office space than we used to need. We need more housing space than we used to need. And I think we're going to continue to need more industrial space as e-commerce becomes more prevalent and as AI continues to grow. So over the course of the next 10 years, I expect a lot of the uh, existing space that we don't need as much of, so like some office properties, are going to be repurposed or raised and rebuilt. And additionally, as a result, I think that a lot of these niche asset classes that have not really been top of mind for most commercial real estate investors over the last 30 years are going to become a lot more mainstream because we're going to need a lot more of them. So data centers and cold storage within industrial are two that come specifically to mind.
Like we're working on 3 different office conversions right now, so that's not uber surprising. In terms of that, one of the things that has been surprising for me personally is I've learned a lot as I've gotten older. I definitely made some mistakes as a young man, and I'm curious if you could give yourself advice when you were, let's say, graduating high school. What would it be?
Yeah, you live and you learn, and that's where the experience comes from, right? Well, it's it's a bit cliche to say that real estate is a relationship business, but it really is. Um, I talked about this recently on a podcast, how AI might impact some of the information asymmetry that kind of characterizes our industry, but real estate is still really characterized by information asymmetry, which just means that you don't always have the same amount of information as someone else might in your nearby networking pool. So, all of that to say, the more people you know who want to work with you, the better, because that's how you're going to get information about off market deals. That's how you're going to get information about uh, sellers that are motivated for reasons that would lead possibly to a good purchase price. So, if I were to talk to myself 15 years ago, I'd say, make sure that part of your professional development is a steady diet of networking. Meet as many people in the industry as possible, but also network with people outside of the immediate commercial real estate industry. And part of the reason I suggest the second aspect is that it is whenever you just talk to everyone in your own industry, you're more prone to groupthink, right? You get these information walls, your information becomes a little bit more siloed. So when you're meeting a lot of people in your industry, you're increasing your opportunity, or you're increasing your chances for opportunities coming in your direction, especially if people want to work with you. And by networking with a lot of people outside of the industry, you're able to kind of like check and be skeptical of some of the things that are considered common knowledge within commercial real estate. So that's the first thing. And then the second thing, I'd say balance this diet of networking with a constant acquisition of technical skills, which I think, especially if you're starting out, is particularly important. I know that AI will change how things work, but like you can't be a junior analyst if you don't know how to build financial models, if you don't understand how debt works in relation to the broader capital structure of a particular deal. Um, and I still think coding skills is really important as a technical differentiator that may change in the future. But a diet of networking and a constant acquisition of technical skills.
So, one of the ways we like to gain more skills and more perspective without networking is through books or uh, media. And if you could make a recommendation to some form of media that our listeners should either pick up or tune into next, what would it be?
I think the one of the single most important books I've ever read in my life is Thinking Fast and Slow by Daniel Kahneman and Eamon Tversky. And I think this came out in 2014. It was essentially a summary of these two empirical psychologists' life work in studying economic related behaviors. So for example, if you've heard the idea that like the rational actor theory of economics has largely been disproven at this point, it comes from these two researchers' body of work where they've demonstrated that people value downside differently than they value upside. But the biggest takeaways from this book is that we're all prone to thinking fallacies, to cognitive fallacies. There's no escaping it. It's part of how our minds function as human beings. The best we can do is become aware of them. And when we're aware of them, we can try to put up guardrails that that automatically correct one way or another and prevent us from going too far down a fallacy hole. And I think this is really important in the investing world broadly, but also within commercial real estate, because one, it means that you're always going to be a little bit more skeptical of the assumptions that you make. You'll be a little bit more aware of what the assumptions you're making are. They won't just be subconscious. And if you look at some of the winners and losers of the last 4 years, and while we're just in the beginning of the next cycle, I think a lot of sponsors that are struggling right now made assumptions that just were not realistic assumptions to be making in 2021, 2022. And those that didn't manage their debt a little bit more cautiously because they didn't know what was going to happen to interest rates in the near future. So being aware of how the human mind can fail you even when you're really experienced, I think is one of the best ways, one of the best things you can do. This book's worth a read.
So one of the best ways that we like to expand our mind is network, and it's the topic that you brought up earlier in our final four. The whole point of this podcast is to network and reach out to some of the best people in and around the industry to learn a little bit more about where commercial real estate's going, expand our minds, and expand our network. And so if we're reaching out, who should be the next person we have on the podcast?
If you haven't had the opportunity to talk with Josh Volin at Sire Equity, CIRE, I think you absolutely should. CIRE, Sire Equity. They've been going for about 15 years right now as an independent PE shop. Before then, they worked at where the founders worked at a brokerage and a big acquisition shop. But these guys are great operators. They understand the market. They understand how to create value in situations where people might not otherwise see opportunities. They're repeatedly able to find situations where you have a motivated seller, execute on that project, find affordable debt capital. They're just really smart guys. So if you could talk to Josh Volin, I definitely recommend it. Another name I'd drop is a good friend of mine from school, Sam Bendix. He's at Chicago Pacific Partners, and he works across all different types of asset classes. Josh at Sire started off as a retail guy, but now they're mainly retail and industrial. So you'll learn a lot about how to add value to otherwise less obvious opportunities if you talk to him.
Well, if you can make a connection to Josh and Sam, I would love that. But
Sure.
If somebody wants to connect with you, what's the best way to get in touch?
Well, I'm fairly active on all the typical social medias, so X and LinkedIn. You can find me Xander Snyder, or at Xander Snyder X is my Twitter handle. Feel free to reach out to me just by shooting me an email, xsnyder@firstam.com. Happy to chat about commercial real estate trends and data, and those are probably the best ways to get a hold of me.
Xander, thank you so much for hopping on the podcast, and we have to have you on in the future.
Thanks so much for your time, Gordon. Nice chatting with you.
Thanks again to Xander. We appreciate his insights. And if you enjoyed the podcast, please give us a like, a 5-star rating, and a review. Your comments, interactions, and subscriptions truly matter and help us continue to get quality guests. You can find us on YouTube, Spotify, or wherever you get your podcasts. I'm Gordon Lanfear with the Real Finds Podcast. Thank you for listening.